Amid everything that's going on with ramped up trade talk, it's a good time to bring in Chief Market Strategist Art Hogan. He's with B. Riley Financial. Art, it's great to have you on the show this morning, and a lot of fast-moving headlines today. What do you make of this and what it means for investors?
Yeah, I'll tell you three things. I think, to look at how much the markets retraced going back to election day, we're basically back to where we were before the election. And some of the enthusiasm for markets post the election was that it appeared as though we had a pro-business, pro-growth administration coming into the White House. But the cycle or the cadence of what they're proposing is really the tough stuff first, right? So it's, we're going to cut government spending, we're going to cut a lot of government jobs, and we're going to put universal tariffs on just about everybody that imports things to us. And obviously that's going to be very difficult for both the market and the economy. The back end of that is that doesn't balance off with anything like less regulation or perhaps lower corporate taxes. So we're here at a place right now where investors likely were looking back to the 2018 tariff playbook, where there was a lot of bluster and a lot of tough talk on tariffs, but really at the end of the day, they were just applied to China, just applied to intermediate goods. And before we actually put tariffs in place, we had a corporate tax cut. So there was a fiscal response such that corporates could actually absorb some of the cost of those tariffs. We don't have that now. So unfortunately, we're in new territory here. And now the first question is, how long does this last? How long are tariffs placed out there? And is there a potential for these countries to negotiate their way out of them and come up with some considerations that will make them go away or get negotiated away.
It's interesting. Many of the market strategists, commentators, if you will, that I've spoken to over the past few months, at least since election, said that they do anticipate volatility this year, but it does seem to be a flip in terms of the trade policy, because what was viewed originally as a negotiating tactic with tariffs is now obviously very real. So what should investors be prepared for ahead? Is it more volatility? Is it potentially a further slide?
Yeah, well, the volatility really was induced right after the inauguration, when we just had a fire hose of announcements coming oftentimes on weekends about potential policies. This new administration set a record for the number of executive orders they signed in the first 30 days. And clearly it's hard to navigate those waters when we don't know everything that's being said and what all of those things will actually come to fruition. How many things will actually be done? And so for investors, you really have to try to tune out some of the noise. Pay attention to the news that's important. The news that's important right now is a universal application of tariffs is going to be negative. It's going to be inflationary, and it likely drags down growth. Cutting government spending, while a long-term positive, likely is going to be a short-term negative. It takes a while to transition from the government sector spending to private sector spending, and that's likely 2 or 3 quarters. So at the end of the day, everything that's being instituted right now likely slows down growth, likely ramps up inflation. And one of the only positives is this has pulled forward expectations that the Fed will likely have to cut rates sooner than had been anticipated a month ago.
Yeah. I'm glad that you noted that, because it is perhaps looking increasingly like that. And it's interesting, Art, because you mentioned growth. And just last week, we had seen that the Atlanta Fed indicator, a very reliable GDP growth indicator, does forecast negative GDP growth, or a contraction rather, in this first quarter. Comes at the same time that some of the economic data of late has been soft. So give us a better picture underneath the hood as to what is going on throughout the economy.
Yeah, that's a really good point, Kristen. I think that the Atlanta Fed, while very good, is only as good as the data that it has thus far. So it still has another month's worth of data to calculate the first quarter GDP. Now, their estimate was for that to be up, call it 2.2% 2 weeks ago. And with the incoming data that we've seen, that certainly has pulled back a lot. There's a lot that kind of slips into that in terms of GDP. So when you think about the fact that we're likely seeing corporates bringing on more inventory to avoid tariffs and higher input costs, that's going to have an imbalance in our imports versus our exports. So we may well see a very soft first quarter. I don't know that it'll be negative 2%, but it's certainly going to be softer than the 2% that we thought it was going to be in the positive territory. We still have plenty more time to look at that. I think a better way to look at this is to look at the New York Fed, that is showing 1.5% GDP growth in the first quarter, and it probably lands somewhere in between.
You have a note, Art, called President Trump's first 100 days. What do you expect as we get to day 100?
Well, I would tell you this. I think that at some point in time, the three things that I would expect is we'll have some realization of what the duration of these tariffs are going to be, because we're not really sure what the end goal is here. Now, if it was just about balancing trade, this is certainly not the best way to go about it. If it's to get some action at the borders with both Canada and Mexico, perhaps that makes more sense, and that's something that likely can be negotiated away. I think the second thing to contemplate is at some point in time, this is a president that has measured his success by the stock market, and I don't know how much pain this administration is going to take as the market sells off. And I think they'll try to accentuate some more positive attributes, talking about things like keeping the corporate tax rate at the current level, and certainly talking about some regulatory changes. So right now, I think we're in that quagmire of everything is negative coming out of the administration in terms of markets and in terms of the economy. And I think at some point in time in the next 30 days, they'll likely be trying to show the positive attributes of some of the policy proposals and changes that they have.
Of course, we got that all-important jobs report on Friday as well. We'll be looking at that closely, Art, both in terms of how many jobs were created, fewer are expected, and the wage number as well. Art Hogan, always a pleasure. He's a chief market strategist at B. Riley Financial. Art, thanks.
Thank you.